Right, so let's start looking at operations, which was the first section of the cash flow. Now, this cash from operations is to do with the general buying and selling and the general operations of a business. And to a large extent, most of those are covered by the income statement that you would have already drawn up. This is just an example of an income statement, but if you have a look, sales would be an inflow of cash. Cost of sales represents the cost price of the goods you had to buy, so that would be an outflow of cash. Your income would be inflows. Your expenses would be outflows. Your interest income, your interest expense would both be inflows and outflows. Your income tax would be an outflow. Now, the long way would be to take this income statement and take each item and analyze it and see if you got all the cash for each item. For example, you might have sold goods, but you might not have received the cash. But we do take a shortcut way, and we start off, and instead of taking each item, we pick up with the profit before tax. And then to that figure, we have to do some adjustments. And the adjustments I'm referring to is if you look at this profit before tax, you would have already deducted interest expense. Now, while that is an outflow of cash, interest expense is a material, an important item, and so therefore has to be shown separately. The other thing that we need to deal with is a thing called depreciation. Now, depreciation is an expense. It's already been minused to get to the profit. But depreciation is not a cash outflow. There's nobody paid for the amount of depreciation. So when we start with our cash flow, we have to cancel these non-cash items. And while there are several, at school level, we limit ourselves to just depreciation and we don't worry about any others. So when we start this operations, we do a note because there's quite a lot of calculations that come in. And so the first part, and what I'm going to focus on in this video clip, is the reconciliation between the profit that you've got, which you calculate in your income statement, and how much of that represents cash. So you would pick up your profit before tax. Now, in most exercises, you'll be given that, or you'll be able to calculate it. You're given the net profit before tax over there of 844,300, and then we do an adjustment. We add back the depreciation and we add back our interest on borrowed funds. Now please just take note, this is borrowed. This is all money that's borrowed. It would be your interest on your loan, it'll be your interest on your overdraft. So it's your interest expense, but all the interest expense. Now because you would have minus that before you got your net profit, we now reverse it, and so we add those back. Now we have to do a further adjustment for that, is because we talk about our working capital. Now the working capital is your current assets and your current liabilities, which are on your balance sheet. Now your current assets would be that you would buy your inventories, you would sell that inventory, so you convert it into sales. Some of that will be cash straight away. Some will only come in later, so you convert into debtors or part of trade and other receivables, and then you pay your current liabilities. Now, it's this delay that you might be buying the stock today, but you might not have sold it yet. And if you haven't sold it, those inventories would not be part of cost of sales. If you've sold goods to your debtors, it would be part of sales. It's part of profit. But it's not part of your cash because you might not have received the money. And so we have to do an adjustment for all this. And the shortcut way that we work at school is we look at each item and we take our inventories and we see that your inventories last year were 110,250. And in this year, they're 251,250. Now, if we just break that down, that 110,000 would have been bought last year, but you hadn't sold it. So, if you're selling the older stock first, that would probably be the first amount that would go into your cost of sales. Likewise, these inventory levels here, you've got 251,250. Those will not be part of cost of sales because you've bought it, but you've still got it on stock. So when you pick up a figure of your net profit, that's not going to be totally accurate because not all of that is representing cash. And so we go and we look at our inventories and we say, right, my inventories are 251,250 this year. Last year they were 110,250. So the first thing you need to say to yourself is, what has happened to my inventories? My inventories have increased this year. This is this year, this is last year. Now, from a cash point of view, now when we go to the last column, we're looking at cash. From a cash point of view, that stock that you had last year, the 110,000, you would have bought it last year, but you only will have sold it this year. So that would go into your cost of sales of this year. Your inventory for this year, you would have bought it this year, but it's not part of cost of sales. So while your inventory has gone up, what you've got to say to yourself is, what has happened to my cash? And the difference between these two of 141,000 represents an outflow of cash to you. In a very simple thing, if you bought and sold nothing, if you increased your inventory from 110,000 last year to 251,000 this year, you would have had to buy more stock, and if you're buying more stock, it would mean an outflow of cash. Now, some of this inventories that you've been selling, you might have sold on account. So in which case you won't get the money straight away. You'll sell the goods on a certain day, but you'll only get the money later. So we need to see, well, what has happened to my debtors? And if we look at your debtors here, you had 76,000 last year. Now that meant you sold the goods last year. They would have gone into last year's profit. But you wouldn't have received the money last year. That's why they were still as debtors. So by all accounts, you would have received that money this year. So the 76,000 will have come in this year. The 60,000, on the other hand, that you've got now, would be goods that you have actually sold, so you've made a profit of it, but those debtors have not paid you. So if we do the same thing again, my debtors have gone from 76,000 to 60,000. So there's been a decrease in debtors. The difference between the two is 16,000. So while your debtors have gone down, what effect has that had on the cash? And in the most simplest way, if your debtors owed you 76,000 last year and they only owed you 60,000 this year, they must have paid you the extra 16,000, which will represent an inflow. Even if in between this there's been a lot of other sales and a lot of buying, the point is the only way their balance could have gone down is they must have paid more than they bought, and therefore that represents an inflow to you. And then lastly, we look at our creditors. Now the creditors are the people we owe money to. Most of it is probably for inventories. So when I say to you what has happened to your inventories and what has happened to your cash, some of that might be that you hadn't paid it, in which case you still owed creditors. The important thing is creditors are people that you owe the money to. You have not paid them. And so until you pay them, the money is sitting in your bank account. So last year, you owed your creditors 220,475. This year, you owe your creditors 209,945. So you have paid off all of that 220. You would have bought more goods, you would have sold, you would have paid more, but by the end of the day, your actual creditors have gone down. The difference between these two creditors figure is 10,530. So the first part of it is pick up the figures and subtract. That's easy enough to get that. More involved is, right, if my creditors have decreased this year, there's been a decrease in creditors, what has that done to my cash? So I would have paid off. I owed them 220. I only owe them 209,000. I owe them less than what I did. Why? Because during the year I've been paying them and I've been buying them from them. But I must have paid more than what I bought. And that is why the balance has gone down. And if I've paid more than I bought, it's going to have a negative effect on my cash. Now this is quite complicated, I know, and you've got to keep your wits about you with it. Just one thing to notice, although on this sheet it's got debtors and creditors, and likewise in here in the question paper it said it was only debtors and creditors. Trade and other receivables can be made up of expenses prepaid and income receivable or accrued income. Likewise, trade and other payables can be made up of accrued expenses and income received in advance. And you need to take those accounts into account as well as the debtors and creditors. It's not only creditors. Because if you've got income receivable, it means somebody owes you an income, just like a debtor owes you. So if you're in another exercise, they show you trade and other receivables, and they show debtors, prepaid expenses, accrued income. You need to add all of those up to get to subtract the two figures from each other. Right, so finally to finish that, we had a negative outflow on inventory. We got in more from our debtors, but we've had a negative outflow on our creditors, and overall this is a negative outflow of 135,530, because there's more negatives than positives here. And so from the first part, our income statement, we might have got in R1,000,000, but we've had to spend money on debtors and inventories and creditors, and so if we subtract these from each other, we finally left with 906,720. The answer to the note, which will then move into your actual cash flow.